now you've really got to pay attention, because now we're starting with the actual working. So now we've covered the theory. All the theory's done. And then we can now look at this, the actual calculation. So I'm focusing on relevant costs. Relevant costs are important. Why? Because of decisions. We make decisions based on the costs. Okay, and that's why we spoke about those what, the why, and all of that previously. So here is the analysis. So once I've decided, okay, great, I'm going to go buy the tablet, or I'm going to start the new job, whatever the case might be, now we need some analysis. Okay, so what's the initial investment? What do we say the initial investment is?
Well, buying the tablet.
Correct. It's the first step in the timeline. So remember, in previous modules, okay, in Fin 2601, you were given the costs. Do you agree? You were given the initial investment at time 0. Do you agree?
Yes.
And all you had to do was type that into the calculator, and then the calculator gave you the answer, right?
Yes.
Okay. In this module, in Fin 3701, you are going to have to find the values for the timeline first, and then you're going to have to put that into the calculator to get a decision.
Sure, okay.
Okay. All right, so when calculating the initial investment, this is the formula. Okay, and this is the formula they use in the textbook. This is the formula that we have to use in terms of actually providing the information in order to make a decision. Okay, the analysis.
Okay.
Right, so when calculating the initial investment, I need the cost of the new with installation costs. I need to subtract the after-tax proceeds from the old. Why is the old relevant? Because it's a decision to replace.
Okay.
And that'll be proceeds minus the tax, and then I add or subtract the change in net working capital. And that's how I get to the initial investment.
Sure, okay.
So the initial investment is right at the beginning. It's at T0. It's the INV. That's what I'm trying to calculate. In order to get that, I need to calculate it using this formula.
Okay.
Right, so here's an example. I want you to read the example and highlight things that are important. Quickly do that.
Okay, so I said replace the
Good.
old.
Why? Why did you highlight replace?
Because we're gonna forget about the old now, so it will be an
No. Expansion, you don't worry about the old. Replacement,
yes,
you
I'm
do.
saying we're eliminating the old, so it's going to be an expansion.
No, you're replacing the old. So it isn't expansion, it's replacement.
Okay.
Okay, so is the old relevant?
Yes.
Correct, and that's important. See, that's how you do it. So I need to look at the old because this is a decision to replace. Great. Okay, how much does the new machine cost?
What, 2 million?
Correct. Do I need to install it?
Yes.
So how much does the actual machine cost?
2.2.
Correct, there's it there. Okay, so here's the install cost of the machine. Is that alright?
Yes.
Okay, great. Right, now we need to look at what? Let's go back to the formula. The formula gave us step number 2. What do I do with step number 2? After-tax proceeds from the sale of the old asset. Do I have the proceeds of the old?
No.
Really? What's the proceeds of the old asset?
We don't know.
What does it mean, proceeds of the old asset? If I sell the asset today, how much am I going to get?
Sorry, I didn't read down that's 600,000.
Yes.
Sorry, I didn't read the whole thing.
Okay. This is the proceeds from the sale of the old. Do you agree?
Yes.
Okay, so now we've got this. Okay, then I need the tax on the sale. how do I calculate tax on the sale of an asset? Have you done tax yet, Tammy?
No.
You haven't. Okay, so you have done accounts though, so you're familiar with carrying value, right?
So.
How do I calculate carrying value? Cost minus accumulated depreciation.
Yes.
Okay, so when I look at the carrying value of the asset, I need to work out that. So I need to know what is the carrying value of the asset. Well, how old is the asset?
For 5 years.
No.
2 years.
Yes, the asset is 2 years old.
Okay.
So I'm depreciating the asset over 5 years straight line. Okay, so how much depreciation will I have each year?
But why? I don't understand that 5 year if it's only 2 years old.
Okay, you bought the machine 2 years ago and the machine has 5 years of useful life. Makes sense?
Okay.
Okay, so you can use this asset for 5 years and you'll depreciate it for 5 years.
Okay.
Okay, so how much depreciation will I have each year?
Well, 5 divided by 2.
No, 800,000 divided by 5. Because remember, this is the straight line method. Remember your accounting, straight line depreciation?
Okay.
Okay, so 800,000 divided by 5 gives me the depreciation per year. What's 800,000 divided by 5?
I don't know.
Add the calculator, divide by 5, you should get 160.
Ranges.
160,000. Okay, so now we know what the depreciation is. How do I get the carrying value?
The cost.
Which is what? 800,000.
Yes.
That's the cost. Then I need to minus accumulated depreciation. How do I get accumulated depreciation? How old is the asset?
2 years.
2 years. How much depreciation do I have each year?
That 160.
Correct. So if I've got 2 years of depreciation, how much will I have?
Times 2. 320.
Correct. Okay, so what is the carrying value of the asset?
The 800,000 minus the 320,000, so it will be 48, I think.
Good. Okay, so now you've got the carrying value. Right, so how do I work out if there's tax on the sale or not? Well, did I sell the asset at more than its carrying value?
Yes.
How much was the asset's proceeds?
600.
Good. And the carrying value is?
480.
Good. So is there going to be a profit or loss on the sale?
Profit.
Good. Is the profit going to be taxable?
Yes.
Correct. Okay, and that's how we get the tax on the sale. Perfect. So I'm going to go to the slide, the next slide. There's the tax on the sale. So we just did all the calculations. Okay. 600,000 minus 480
Yes.
equals 120,000. What is that? That's the profit on sale. Happy?
Yes.
Okay, and how much tax do I pay on profit? 30% in the notes.
Okay.
So 30% of my profit will be taxable. So the tax on the sale is 36,000.
What? No, what's that 36,000 for now?
36,000 is the tax on the sale. We just worked it out. 120,000 times 30%.
I didn't work that out. Sorry.
Okay, that's the profit on sale. The profit on sale will be taxed at 30%.
Let me just check here. Okay.
Good. All right, then if we go back to the question said net working capital is expected to increase by 30,000. Okay, so all I have to do is just pull that through to my working, and that's where I got the 30,000.
Okay, but what is that net working capital?
Net working capital, that we'll actually learn about in 3702. So the next module, that short module, that's looking at net working capital. Working capital, remember, is your current assets and your current liabilities. It's the short-term finance that you have available for short-term obligations.
Okay.
Okay, so net working capital is what we need to sustain the business.
Okay.
Okay, and then once you've got that, then I just need to apply the formula and I get the initial investment. Okay, so let me just erase this. Those amounts give me that answer over there.
Where does that 564 come from?
It comes from this. Proceeds less the tax on sale.
Okay.
Okay, any other questions?
No.
Okay, great. Alright, that's the first calculation that you need to do to draw what? The initial investment. Okay.
Okay.
Alright, next bit, OCF, operating cash flow. Operating cash flow is where? Over the life of the project. It's operations. So now I'm looking at this. OCF, 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 OCF. I'm looking at the cash flows over the life of the project. That's what I'm looking at in terms of the diagram. Make sense?
Okay.
Okay. So we've got two scenarios here. With the new machine, revenue and expenses for the next 5 years are expected to be that. And with the old machine, revenue and expenses for the next 5 years are expected to be this. Okay, so you've got old and you've got new. Is old and new important?
Yes.
Why?
Because we're doing replacement.
Correct. Okay, this is replacement. Nice. Alright, so let's have a look at the new machine. Here's the new machine. Does the new machine's revenue and expenses change over the next 5 years?
No.
No.
Yeah.
So I've done one table here, but this table is actually applicable for all 5 years. Okay, so I don't have to do 5 tables. I just need one. Because they're the same for all 5 years.
Okay.
Happy?
Yes.
Okay. What was the revenue for the 5 years?
Let me just go back to that page. Okay. Yes, the 3520.
And what was the expenses?
2.3.
Correct. That's where this comes from. Okay. How do I get this? What asset am I viewing?
New one.
Correct. So what is the cost of the new asset?
The 3.2.
No, cost of the new asset. 3.2 isn't the cost of the new asset.
Why?
2.2.
Oh, yeah, sorry.
Okay, the cost of the new asset is 2.2 million. How long are we going to depreciate this asset for?
5 years.
Correct. So How do I get the depreciation here? 2.2 million divided by 5 years gives me the depreciation.
Yes.
Okay. How do I get taxes? What is tax calculated at? What percentage?
30%.
Correct. So this is the EBIT less the tax gives me the net operating profit.
So I'll say, but where do I get that 780 from?
I take this amount minus the depreciation. It's the subtotal.
Okay.
The one minus the other. One minus the other.
Okay.
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 All right.
And then
so
the 780. So the 780 minus the 30% equals the 234.
No, the tax is 234. 780,000 times 30% is the actual tax.
Which gives you the 234.
Yes.
Yeah, that's what I asked.
Correct. That's the tax.
Okay.
Right. Then you minus the tax from your EBIT and you get the operating profit. That's another subtotal. Okay. Why do we add depreciation back? We take it off, then we add it back. Why do we do that?
I don't know.
Is depreciation a cash flow?
No.
No. Depreciation is a non-cash item.
Mm-hmm.
So non-cash items need to be added back because they're irrelevant. You're taking it out of the calculation. Okay, so always remember, just add back the depreciation after you've taken it off.
Okay.
Non-cash items needed to be added back.
Okay.
Right. And then the last line gives you the operating cash flow. So this amount minus that amount gives you that answer.
Okay.
Okay, and that's OCF. So now you know if I had to draw a timeline, I'm going to have 960,000 every single year for the next 5 years for which machine?
New.
The new machine. Okay. Alright, here's the old. If I go back to the old, how much revenue do I get in year 1?
Where's the old one? Okay.
Okay, do we have the same or different amounts?
Different.
Yes, we have different amounts every year. So because the amounts are different every year, I'm going to have how many calculations here?
5.
Correct. Going to have 5 calculations. Good. Okay, so the new machine, I've done the calculation here for you. How do I get the depreciation? We actually got it earlier. Remember we said?
The cost divided by the 5 years.
Okay, yes. So, sorry, wrong slide. This is the old one. Yeah, they're old. Okay, so what was the cost? The cost was 800, and we divided that by 5. That gave us the 160. We did the calculation earlier. We're just pulling through the same amount.
Okay.
Okay. Right, then you take the tax off. You then add back the depreciation, and you get the OCF. This OCF is for the old machine at time 1.
Okay.
Right, would I have to look at year 2, 3, 4, and 5?
Yes.
Yes, I would. Okay, and I've done it for you on a summary. There's the summary there. Okay, so earlier we calculated this. This was for the new machine. Is the new machine going to change year by year? No, it isn't. So we said that was going to be the 5 amounts that we'll have for the 5 years.
Okay.
Here's the old machine. That's the one that we just worked out. This one, okay, those are all for those different years. Year 2, year 3, year 4, and year 5. So you can actually check this. What I would do if I was you, I would take this template, okay,
Yes.
and I would redo it for year 2, year 3, year 4, and year 5. And if you do it correctly, the answers that you get here at the bottom will be those answers that you've got over here.
Okay, I'll try it for homework.
Yeah, so try it. You're just doing the same calculation 5 times.
Okay.
Okay. Right, then if I summarize the operating cash flow, I'm going to have year 1 to year 5. Do you agree? Okay, so if I draw a timeline, I'm going to have cash flows. Okay, do you see we're building the timeline? Okay, because we had the initial investment, which we worked out before, and now I've got this amount, which is at time 1, I've got this amount, which is at time 2, I've got this amount, which is at time 3, this amount at time 4, and this amount at time 5. And those are all your OCFs.
Okay.
Okay, makes sense?
Yes.
Perfect. Right, then the last bit is the TCF. How do I get the terminal cash flow? The same thing applies. Follow a formula. This formula is very similar to which one?
The one we just did.
No, the one we did earlier, the initial investment. Okay, initial investment and TCF, they use the same equation, very similar. New minus old.
Okay, so it's similar. Okay,
so the TCF is what I need in order, or the formula rather, is what I need to calculate the TCF. Okay, but be careful. You need to look at this. Where am I in terms of time? Am I at the beginning, during, or end?
Beginning.
No, terminal cash flow is at the end. Okay, so think about someone who is terminally ill. Terminally ill means they're close to dying if they're in a terminally ill condition, right?
Okay.
Okay, so terminal cash flow means the cash flow at the end. So if I draw a timeline, this is where I am, TCF. I'm right at the end.
Okay.
Okay, the end of the project.
Okay,
that's key. You need to know where you are in terms of time. So when reading information, here's the information at the bottom. Okay, I've told you information at the bottom that relates to the end of 5 years. Okay, so we can sell the asset at the end of 5 years for 400,000 after removal costs. The old machine is expected to sell for 80,000. The company's net working capital will increase by 30. Assume a tax rate of 30%. Okay, so that's the information that we need to do the calculation. Here's the calculation for you. I've given it to you. Okay. The formula looks at the after-tax purchase of the new minus the after-tax purchase of the old. Okay, remember new minus old is key. Okay. So, how much can I sell the new machine for at the end of the life?
400.
Correct. There's the 400. Right. What book value will I have, or what carrying value will I have at the end of its useful life?
Well, I need to take the cost minus the accumulated depreciation.
Correct. But if it's at the end of the useful life, will it have a value?
No.
No, it won't. Okay, so the tax will be on the full amount. Okay, so 120,000 is calculated from the 400,000, which is 30% of 400,000. 30% of 400,000 is 120. Okay, that's the tax on the sale. Okay.
Okay.
Alright, and then the 400 minus the 120 gives me the 280. That's the after-tax process from the sale of the new.
Okay.
Right, so now that's new complete. Now I need to look at old. Okay, so if I go to old,
Okay.
how much is the old going to sell for?
80.
80. Does the old asset have a carrying value?
Yes.
Well, yes, but the carrying value is 0. Okay, so what will the tax be? The tax will be 30% on the selling price.
Okay.
Okay, so 80 minus 24 gives me 56. That's the after-tax process on the sale of the old.
Okay, so that 24 is the 30% on the 80.
Yeah, 30% of 80 gives you the 24.
Okay.
Okay, and then the net working capital was given in the question. I've just put it through here. And then the final answer that you get here is the 254. Remember, terminal cash flow, right at the end. T end is where I have the terminal cash flow.
Okay.
Happy?
I think so.
Okay, great. Alright, so let's paint the bigger picture. What does all of that look like? Okay, so Tammy, go back to your note and give me the initial investment. What is the initial investment? First calculation, we did initial investment of how much?
Let me just quickly get back to it. Sorry, I mixed up these papers now.
Okay, let me go back to it. I'll show you it. The initial investment. What was the initial investment? Look at the screen.
Okay, 160.66.
Okay, so if I go to my diagram, happy. Initial investment. Yes?
Yes.
Okay. Then I need OCF. Where is OCF?
Let me just get to that. That's a 986.
Yeah, there were different OCFs.
Okay. So which one do I look at?
All of them.
Ah, okay.
These ones. Incremental cash flow. Okay, because OCF is new minus old. So I've got 91, 105, 167. 91.
Are we doing the old or the new now?
I'm looking at the net, the old minus the new minus the old.
But if you go back to page 33.
35.
33.
35. Look at the slide in front of you.
Yes.
This is the summary, new minus old.
Okay, but I'm asking you, why on page 33 is there the 986?
Because this is for the new.
Yes, that's why I'm asking, are we working with the old or the new?
We're looking at both. There's the new. There's the new.
Okay.
There's the new. Here's the old.
Okay.
There's the old. And the new minus the old gives me the incremental. That's what I need.
Okay. Let me just write this down. Okay.
Okay, so now I'm building the diagram. 91, 105, 167.
Okay. But where did we put the new one in now?
It's the net amount. It's new minus old. New minus old gives me the final answer.
Okay.
Okay, and then we've got 67. 181. $195. Okay, so everything in blue is the OCF, right?
Okay.
And then what did we have right at the end?
TCF.
And what was that?
254.
Yes. Okay, and you see, now we've built the timeline. Now you'd be able to then calculate those amounts, NPV, payback period, IRR, because now you have all the cash flows. So notice, you weren't just given the cash flows, you were actually told to work them out first, then you'd have to work out NPV, which we'll do later.